Moderating today's session is David Brook from Ninefin. So David, if I can hand over to you to kick things off.
Thank you, Adam. I don't have a mic. Do you have a microphone?
Yes, we're all mic'd up.
Use this.
I think that corner.
Use this.
Is anyone mic'd? I'm not mic'd.
I'm mic'd up, I think.
Yeah. Oh, okay.
I think Alan has it.
Oh no, I feel like a professor now. Okay, well, thank you for all coming to the panel today. My name is David Brook. I'm a private credit editor at Ninefin. We're a relatively new vertical covering this space in the US, covering everything from asset-based lending to corporate direct lending. I will now let the rest of the panel introduce myself. Once, I guess we'll get to Alan eventually when he kind of gets mic'd up, but Scott, if you'd like to begin.
Sure. Hi, everyone. Scott Rosen. I'm a partner at Ares Management in our alternative credit group. Ares is a $300 billion alternative asset manager focused on pretty much every private market that you can think of. I sit in our alternative credit group, which is a $30 billion group focused on lending, buying, and partnering with companies that produce asset portfolios. We play in pretty much every type of asset class you can think of, from royalties, oil and gas, corporate credit, specialty finance, trying to become partners with company with everything from rated products through equity co-invest.
Rajan Arur, I'm a managing director in private fixed income of Sun Life Capital Management. Sun Life Capital Management is the asset manager for Sun Life Lifeco, headquartered out of Toronto, Canada. We have about $270 billion of AUM, 50-50 between the Lifeco's general account and third-party funds. The private fixed income focuses on, across the duration, infrastructure debt, project finance, large corporate private debt, sponsored credit solutions, but I focus primarily on the specialty finance and securitization book.
Hi, good morning. I'm Mukund Narayanan, managing director at Fortress Investment Group. Fortress is we're over 40 billion in assets. We invest across the credit spectrum: corporate credit, asset-backed, real estate. I focus on asset-backed public and private investments.
Hi, is this on? Can you hear me?
Not yet.
Hello? All right. I'm Alan George. I am the head of structured products for Golub Capital. Sorry about that. We are approximately $70 billion asset management firm focused primarily on senior leverage products for private credit as well as broadly syndicated loan. We're the third largest CLO manager in the United States, as well as a frequent issuer of recurring revenue ABS. As the head of structured products, my focus is on all the debt raising for the firm across various debt capital markets.
Thank you. Thank you, everyone, for introducing yourselves. So I appreciate that. So private credit, we can't just stop talking about this. I guess it's finally great for you guys that it's fashionable. I wanted to begin, though. Is it the golden age or is it the golden moments of private credits? Mukund, maybe you want to kick off?
Sure. I don't know about golden, but it's definitely very interesting times in private credit. I mean, your traditional sources of capital, like bank lending, has taken a step back, to put it mildly, and your public debt markets they're open, but mostly for the high quality, the top quality borrowers and assets. Equity valuations, whether it's for assets like commercial real estate or the corporate private equity, they're under pressure. So, raising equity at the kind of valuations that borrowers are looking for is also somewhat challenging. So that kind of leaves a good spot for private credit to play in and fill those gaps. But it's also, I think it's also going to be, it's going to be interesting, but it's also going to be pretty competitive because we know the kind of capital that's been raised for these strategies. So it's going to be interesting, I think.
Golden age, then?
Yeah, I mean, I think if we step back again, I think these are the times that private credit kind of live for, I guess. Leading up to just from the GFC up to maybe 18 months ago, we were in such a low interest rate environment, and money chasing assets and people just doing deals at ridiculous rates. And then now we see finally some sense of normalcy coming back. I mean, hopefully this is not the new normal, but certainly looks like we are not going to go back to those low rate environment anytime soon. But certainly, so we have seen a lot of deal flow, and it's more capital raise and other aspects of things that it's finding it more challenging now. Okay, now we want a deal flow. We got that. Now find capital to put to use. So that's certainly a very interesting time, and a lot of opportunities out there.
I'll be more blunt. I think it is the golden age for private credit, but I'd add private credit and insurance, which really just means you look at the market today, the private markets are just taking so much share away from what used to be in the regulated bank markets. Like, I'll be frank, for the last 9 months, I think we've been putting on the best credit risk of my entire career. Because we're doing stuff that used to be done by banks. We're just doing it at private credit returns. But I think, and look, that's great for our investors, but on the flip side, it's also good for companies. What you realize through the years of working with banks is they're intolerable, right? Their credit committees don't say yes when you need them to. They ask questions that aren't based on your business because they have boxes they have to check. And the private markets are creative. They tend to try to solve your problem first and back into a structure from there. So it just creates a better long-term play for businesses to use the private markets.
And Alan?
I would agree with that. I would say I don't think this is momentary in any way. We've been doing this for a long time, especially people on this stage. There's a value that private credit brings. That's what we're really saying, and I don't think that's going anywhere. What's happened is private equity continues to grow as an industry, and private credit markets are growing alongside them. And when syndicated markets close, private credit's been there, and it's been a long-term, stable risk return profile, and that's really catching on with the equity investors in this space.
Scott, you mentioned the kind of creativity of private credit, and that can mean a lot of things, I guess, especially compared to what maybe kind of banks can do in this kind of market, and perhaps that's where private credit find its niche. But I'm curious, maybe can you elaborate a little bit?
I'll take it to most basic. When I look at a deal, it's sort of simple of how we get it through is this deal going to get me fired? Right? That's how people on the private credit tend to go through it. It's not is it 1 times fixed charge coverage, is leverage less than 4? We don't go through it that way. At the end of the day, usually when you're providing capital or credit, you're looking at the overall picture. Do you think it's a good business? Do you like the management team? And you're seeing lots of creativity in the markets today, whether that be in providing PIK capacity, providing delayed draw capacity, covenant features, amortization sweeps. Like, you look at the fund finance market as a great example of where creativity is coming in, where there is no form term sheet, because every single GP has a different view of how to finance their business and the rules they don't break. And that's the fun of our job, is just being creative and trying to find a way to price the risk properly, because you can usually solve one problem by creating another solution on the side that works perfectly fine.
Interesting. I mean, thinking just about the borrower perspective, private credit can come with these flexible solutions, and I'm just curious about the types of borrowers and the conversations you have with your borrowers when they come to the market. Anyone?
Yeah, I could jump in. I mean, from a borrower perspective, you have obviously a wide variety of borrowers, and anybody of meaningful size. It's a question of diversifying liquidity, right? I mean, it's one thing to go after the lowest cost of funds, and obviously everybody wants to have a bank line or a bank relationship and go to the public market to fund. But we know some of those markets are a bit finicky. They could be there one day, not there the next day. Execution is not certain. So that's where, as a diversification ploy, if you have a private credit funding relationship with one of the stable providers, and with a lot of, we are an insurance company that has an asset manager, and we are approaching it that way, but we know a lot of others are asset managers that have acquired insurance companies in the last little while. So that market is changing. So you have a reliable source of funding that is going to play, and we have been in this private market for 40 plus years. So we understand, speaking for ABS where I focus, we understand the market, we understand these deals ebb and flow a bit from a performance standpoint, underlying portfolio, but we know that this has stood through cycles. So borrowers, it may not be your sole source of funding, but it's a diversification ploy from that standpoint, and you get certainty of execution.
Interesting. And perhaps yourselves?
Totally agree there. I mean, it's from the borrower's perspective, it's all about, like, in this state of the market, it's about diversifying their source of funding and capital. They know that, private credit can be really creative and flexible, but accordingly somewhat expensive. But they're okay having these multiple channels of financing, which is incredibly important for them.
Interesting. In that kind of flexibility you just kind of mentioned just there, the extra cost of private credit for borrowers. So borrowers are willing to kind of, in this market right now, cough up a little bit more for that type of flexibility?
Yeah, absolutely. Like, if you look at asset originators, for example, right? They're able to tap the ABS public markets to get pretty efficient source of financing, but they also would like to diversify by going away and getting capital from the private credit market as well.
I'll hit that for a second though, because I don't think it has to be more expensive. Like, let's take the curve out of it. Like, none of us create that. That's just, we all face that, and so do banks. If you look at large asset managers like Ares, we have insurance solutions now where if we can get to a rating on it, we compete head on with banks with just as efficient on the pricing side, and you're now dealing with someone who is more creative and just as price efficient, which is why you're going to see the insurance carriers taking share from the banks along with private credit.
Interesting. When you talk about Ares and the kind of range of options you can provide to borrowers, and we read the Widen the Gap very much report recently, are we going to get to the point where maybe you don't want to be called private credit funds the same way private equity firms prefer to be called asset managers?
I view myself as a partnership provider. You can call my fund whatever you want, but that's the fun of what we do, is like we describe it as we have a full menu of ice cream flavors. You can tell us what flavor you want. And the reality is we can be your rated provider on one side, or we can be your equity provider. We can do both, and it's a question of how we can become partners. But that's where private credit has gotten to, which is really alternative asset management, is being a full one-stop solution for companies.
And Alan, that's a kind of similar story at Golub, a very large institution providing a lot of kind of options. Perhaps maybe you can talk to a little bit of the borrower sentiment and when they come to you, what type of options they're looking for?
Yeah, I think the one-stop is a good term. We call that our unitranche, right? What we're really trying to do is provide the most value to our private equity firm clients, right? We view ourselves as a client service firm to the private equity industry, right? But we're very narrow in our focus. We do first lien lending, small equity co-invest, a little bit of opportunistic credit, but the majority of our $70 billion is in first lien credit. So the way we apply that can be very unique based on the needs of that business, of that sponsor, and where we're winning, especially away from the public sector, is by being creative, by being growth oriented, and by providing a unitranche product where you can do that very quickly and efficiently with either one lender or maybe a small group of us who are like-minded in terms of solving for that growth, knowing that if you have liquidity concerns or global pandemic hits, that it's easier to solve that with a small bank group of partners than it is to fight for amendments or raise new equity or raise mezzanine debt to find liquidity solutions. And that's really what we're talking about. So when people are choosing Golub Capital or people are choosing private credit in the first lien loan sector, they're really doing it knowing that we are solving a need for them, and we're going to be able to be a growth partner for them over a long period of time. If they want a syndicated solution, we can offer that too, but it's easier to grow into a vehicle with one lender where we're giving you multiple delayed draw term loans, you have the scheduled acquisitions you want to make, and we can do that as your primary lender.
Interesting. Just on that corporate direct lending side, because we're seeing increasingly larger and larger unitranche financings and very much that blurring between banks and private credit, and that kind of follows a lot of strategies where what was once the bank's domain is very much in the private credit territory. But I'm interested in that kind of corporate direct lending, unitranche growth. Is that set to continue? It seems like that's kind of going to continue as the trend. McCunn, maybe you want to take that one? Or
I'm sorry, on unitranche.
Just the growth of unitranche financings. Perhaps, is it a good thing?
I mean, it's probably more relevant for the corporate lending
Leave it
market.
outside of the world. Look, the private unitranche, which is the old school combination of a first lien mezz or a first second lien deal into just one loan, has taken over the entire leverage buyout market. I'll say this at my IC on Mondays and Thursdays, I'm going to guess 95% of the deals presented are unitranches. Every once in a while, you'll see just a stretch senior deal is what it's called. But the reality is private equity sponsors, for the most part, have figured out that it's easier to partner with private lenders. They can still put a club together of all the lenders they want to take care of that they work with. It's a more scalable solution. It doesn't require ratings. And in today's markets where, let's be honest, fixed charge coverage is a lot tighter than it used to be, you can still get a fully levered capital stack that the rated markets, for the most part, aren't going to provide unless you've got north of 500 of EBITDA.
Interesting. Alan, can you add to that, or?
Yeah, I would say it's 90+% of what we do as well, but it's very borrower specific. It's not suitable for a manufacturing company, right? So as you go through the landscape, you have to understand that there might be hard asset lenders, there might be lenders who are doing traditional first lien loans for a reason, right? But the unitranche product is really designed for high enterprise value businesses that have a good growth trajectory where we feel good lending that deep into a first lien part of the structure. We're getting paid to take a little bit extra risk through that, partway through that second lien, but it's really reserved, at least at Golub Capital, for what we see as the best credits, and that's what we're trying to lend to. So I think it's going to continue to be something, for all the reasons that we just discussed here, around the value and the scale and the flexibility and timing of execution is going to be very relevant for a long period of time, but again, it's not meant for everybody.
Interesting. Where does stretch senior and a unitranche begin?
Made up math, but I'd probably tell you quoting debt to cap is probably an easier way to do this. A senior deal is probably a 20% to 25% debt to cap, and unis are 30 to 40. Like, that's the interesting part in today's market, is everyone's talked about interest rates where you would expect valuations to compress. There's been maybe a handful at most of deals at committee where the total third-party debt to cap is above 45%. Like, I remember when I started my career, it was 70% debt, 30% equity. That's how LBOs worked. When you see one of those at committee now, you're actually shocked and you're like, what's wrong with this?
Interesting. I guess a broader question for all of you, because I know you all manage very different, varied strategies. So I will come to you, McCunn, this time with a better question in terms of, with the changing interest rate landscape, how maybe have you adapted your strategy working with borrowers? Or, yeah, sorry.
So the changing landscape of...
Yeah, the changing interest rate landscape. Have you kind of maybe adapted your strategy, the way you've talked to borrowers, the way you've kind of financed deals?
Yeah, so, in our book, for example, we have relationships with originators that we constantly fund year in, year out, and a lot of them are long-term. So, obviously, in those instances, they had less of an issue because they were able to term out their originations fairly quickly. So they didn't have too much issues. Obviously, some of them did. Some of them who had a bit more flexibility, they were, obviously have the view that, the interest rates are going to come back, it's not going to stay here, so they held on to some originations and then realized 2 months later that, oops, we are now another 50 basis points out. So there was those happening, but larger players, larger issuers that warehouse deals and then do a term takeout, once a year, twice a year, I think they were kind of burnt a bit where margins got compressed. Rating agencies said there is not enough excess spread, so deal was structured, then rates moved, so you got to throw in more assets to make up. So there were a number of those type of challenges that people faced. From our perspective as largely a fixed rate investor, we match fund our deals on the liabilities of the life co, and so we look for fixed rate investments, and that gives the funders, as the borrowers as well, they know their exact margin as soon as they fund the deal. And as a result, the focus was always, to have a relationship where you are constantly funding, and it's a, we have a constant touch point with the originator base. So it felt, as you looked at private deals and 4A2 type deals that we worked on, that's where some of these challenges were faced, but where we had constant long-term and consistent funding relationships, this was less so.
Interesting. And McCunn, maybe?
Sure. I think it's incredibly important to have like a deep conversation with the borrower to understand the exact need for the capital and what they're going through in this higher interest rate environment, how it's impacting them, and how the capital that we're going to provide to them sort of stabilizes or improves their situation. So I think we've been incredibly focused on that, and also trying to build as much cushion as possible for any potential pressures on valuation, and trying to remain senior in the stack, and maybe attach at a point where we feel comfortable stepping into the asset if needed. I mean, you're supposed to be willing to play pretty much in any part of the stack, if even the equity if needed, if things don't go the way you plan them. So
Interesting. And Alan?
Yeah, I think interest coverage is obviously topical across the board for many reasons. When we're structuring new loans now, I think interest coverage is the new leverage, right? Before you were optimizing the deal structure based on maximum leverage and what was tolerable and what was able to be achieved in the marketplace. And I think leverage is lower, but you're really optimizing for interest coverage. And so it's challenging because the best companies out there can still achieve a good loan structure with good leverage, but interest coverage might be 1.1, 1.2, maybe 1.5 on the higher end. But you have to, I think that the story when we were explaining why we got comfortable with higher leverage unitranche is similar when we think about structuring a new loan that's closer to 1 times interest coverage, because you have to factor in all the other intangibles. What's the enterprise value? What's the growth rate? What sector are they in? Who's the sponsor? And so you can get comfortable the same way we would get comfortable when we were having that leverage conversation a few years ago when unitranche was newer and growing. And so we have to factor that in. And what we're concerned about is what are the downstream impacts. We want to lend to the best companies we can find. If they can get a deal done at 1.2 times interest coverage, but we think they're going to grow 10, 15% a year, we're okay with that. But what do the rating agencies view? What's our investor base thinking about seeing lower interest coverage across the board? And then we're having this conversation across all our banking counterparties, all of our rating agencies. But we still want to be in the business of financing the best credits. And if that means they can get deals done where they're optimizing for interest coverage, then so be it. It's a period of time that we all have to live through together.
Interesting. What are those conversations like with the borrowers, with the interest coverage ratios coming down? I mean, what are those conversations like, I guess?
In terms of companies who are seeing interest coverage decrease?
Yeah, and like maybe seeing the forward-looking picture of the economic environment and solutions.
I think we all probably feel this way. This is the value in being a private lender, right? You're having a direct conversation with the management team, with the sponsor about where things are going, what their liquidity looks like, and if liquidity is stressed, what are the solutions? And then build a solution that works for the sponsor, that works for Golub as the lender, and drive forward. And we just went through the biggest liquidity crisis that any of us has ever seen during COVID, and came out the other side quite well. So I think where we're situated today, we feel very comfortable. The portfolio companies that I'd say are considered the most stressed are maybe 1% of the entire pool. And we're factoring in higher interest rates. But what we're continuing to see, even though there's some companies where interest coverage is dropping, what we think is the portion of our portfolio that stress is very small. We're seeing top line revenue growth and now bottom line growth across every one of our industry verticals. Talking 7-8% for industrials and consumer, 10% for healthcare earnings growth, 26% in software. So we're seeing interest coverage tighten because interest rates are growing so fast, but the companies are quite stable. So I think it's just a momentary difficulty that we're all going to live through, but we're not at a period right now where we see real significant stress that we saw at COVID.
Interesting. Is that kind of maybe everything that looking at your portfolios as well? Interest coverage ratios is concerned, how maybe those conversations are going with borrowers?
I think at some point this matters for where your portfolio is and what sectors you're focused on. But I'd agree with that. Like our portfolio is very healthy. Our non-accruals are at the lows. I think the reality today just is with cost of capital is that companies just need to go back to the capital markets or their lenders a lot more frequently than they used to. You used to, money was free for 10 years and it's not free anymore, and so you just have to manage those relationships a lot tighter than you used to. But the capital markets are still efficient for companies when they want money today. It's just, first lien debt costs 11% today. There's no solving that. It's just, SOFR is what it is. So if you want under 10% paper, you need to get an investment grade rating. It's just a reality of life now, and it takes a little bit of time for everyone to accept it.
Absolutely. And then kind of broader portfolio management, I guess, Rajan, as well. Maybe talk to some of maybe your concerns in your portfolio management, maybe how you may be handling some of the difficulties.
Yeah, I mean, I guess, we monitor our portfolio fairly closely. All our deals report monthly on the portfolio and on the, all our deals are in our portfolio are non-recourse deals, so we rely solely on the underlying cash flow of the portfolio to repay our funding. What we rely on the servicer is obviously just the servicing, the originator servicer, and we monitor their financial condition through some financial covenants we have. So, to Alan's point, interest coverage ratio may be less of a focus for us, but what is of their tangible net worth and can they keep the lights on if volumes dry up for a period of time? If they choose to not do volume, can they survive? Is there enough cash flow to keep them going? Because obviously we'll have under our deals ability to take servicing elsewhere if the performance deteriorates, but that's kind of a last straw, and we don't ever want to be in the situation where we have to pull servicing, ideally, because it's best serviced by the originator themselves. So we monitor those. Performance-wise, it has varied. I would say, the subprime sector, we can see a little bit of an uptick in delinquencies and such, but still fairly manageable. And it all comes down to the structuring and what have you, because again, we are a senior investor typically in the deal. And so the question is, do we have enough skin in the game from the originator services standpoint? Do they have equity in the deal? Obviously, if there are sub notes and other participants, we are protected, but that still does not, if they don't have a skin in the game, the servicer, then that still leaves a little bit of a gap. So our key focus is management experience. Have they worked through cycles, and do they have a skin in the game? And from a performance standpoint, yeah. So the subprime portfolio, there is a little bit of noise. Prime portfolio, consumer side is fairly okay. Again, I think a lot of this is to do with where the unemployment levels are, which still seems to be fairly strong. Commercial side, I would say trucking, we see a bit of noise, and it's been impacted with all the supply chain going away. The freight rates have come back up a bit. For a period of time, they were fairly low. Gas prices have been fairly high, seems to stabilize. So people are trying to, I think, come back and manage a bit better now, but for a period of time it's still not out of the woods yet. I think large ticket equipment and all have been performing fairly strong. But as a sector, I guess ABS generally has performed well if you are sticking to kind of the senior level of funding. And overall deals, we have seen some support from in the subprime world originators like US Auto and others. There is some challenges there, but we also have seen others come out, step up and support the deal. So I think the key is how strong their balance sheet is and how can they manage through a period of volatility in the market.
And McCon, maybe talk to a little bit maybe of the portfolio management, some of the challenges you may be seeing.
Yeah, I mean, asset management or portfolio management has never been more important than right now. And we have an incredible asset management team that focuses pretty much on this every day. And again, I think it's especially in sectors like commercial real estate, it's very important to have these proactive conversations with the borrowers and find out how best to solve the issue at hand. It's, as lenders, we sort of have to toe the line between offering relief or modifications and extensions versus trying to protect your asset, trying to exercise your rights and remedies as a lender. And again, you need to have the expertise to be the equity and sort of take over the asset if needed. So.
I suppose that's kind of the benefit of private credit, the relationships you have with the sponsors. So maybe you're able to anticipate problems earlier, or perhaps, yeah, curious.
I mean, that's where the asset management teams come into the picture, right? They're having conversations as frequently as they can with with the borrowers and the sponsor to try to get ahead of the situations if where possible.
Okay, thank you.
Key part of that for this world that everyone remembers is this is one of the few industries where your financial statements and what you actually do during the day sometimes have nothing to do with each other. And to get to the underlying data, because what GAAP says is happening really doesn't matter.
Yeah, I mean, just kind of alluding to something that Rajan said about kind of going through cycles and being tested. And it's a lot of private credit managers maybe haven't gone through that full cycle. Maybe COVID was a big test, but a very different type of test that we've been talking about compared with what today. So maybe just broadly across the market, are we seeing a big test for a lot of managers that may be a little bit inexperienced, to be charitable? Maybe you don't want to talk about other managers, I guess. Sorry.
Look, I can at least speak to it from the Ares perspective is we've been around for 25 years. We've lived through multiple cycles, and the beauty of our business model at our scale now is an average position for us is 0.3%. So no individual deal matters. So it allows us to run our business on a really diversified basis, which allows us to raise money from the capital markets in multiple forms so that we can keep putting it back out to new borrowers. But look, a cycle with cost of capital right where it is right now is obviously going to test different managers and test different industries. That's for sure. But part of the allure of private credit is we can be patient too. Like, I do not want to own any of the companies I lend to. That is a terrible use of my time during the day, but I'm not afraid to. We will stick around with our companies to get the best return for our investors possible, and sometimes that means owning it, but it's not the area you want to go to.
Yeah, I mean, in our book, we are a relative value player. So, the funds get allocated to public bonds where you get in and out and liquid market and what have you. And then if we need access to the allocation, then we have to bring in some relative value for comparable deals. And so our focus is obviously, you can't enter into the private credit deals assuming life's going to be good and you're at the top of an economic cycle, right? So you got to enter into it assuming things are going to go bad, and how are you going to deal with it? And has the management experienced this in the past? How did they deal with it? Right? The portfolios that we own. So it's a cycle exercise, and that's where experience and doing it in the past and having various deals, portfolios in the same sector helps, because you have a line of sight into how these things perform. What are the differences? Again, past experience is great, and a lot of people rely on it and should rely on it. We rely on it too, but it need not exactly mirror what's going to happen in the future, because it could be very different, right? I mean, we had instances in the GFC where people were walking away from their homes. Right? In today's market, and they may not default on their car loan back in the GFC, because the saying was you could live in a car but you can't drive a house to work. So, but today's world, I'm not sure if that's true, because house values have gone up. So would people still drop off the keys? Probably not. So they may default on the auto loan today versus dropping off the house keys. So things change. So people can't say, oh, GFC, this is what happened, so let's go and write all these auto loans, forget the underwriting standards, because they're not going to default because the person owns a home.
That's interesting. You touch on the underwriting standards because we have a question. I'll read verbatim. What are your underwriting standards? Is it on a case-by-case basis? What are the origination sources? Do you use third-party sources, agents? McCunn, maybe you want to tackle that one?
Sure. I mean, it's definitely on a case-by-case basis. We do have views on certain sectors, some top-down views on certain sectors, but within those, it's definitely going to be on a case-by-case basis. And it's important to be able to stress your investments, your scenarios for the regime that we're in terms of interest rates and being in this regime for an extended period, because I mean, I don't know if we or the market fully understand the impact of being in this rate environment for longer than we would like. So I think those are the kind of underwriting that we're trying to apply to our investments. In terms of origination sources, it's all of these, right? Like third-party sources, agents. We have good relationships with the borrowers. There are a lot of repeat deals with them. So it's any and all of these.
Alan, as well. Do you have a
Yeah, I don't
strong
think
feeling?
a lot's changed for us. We originate collateral by partnering with private equity firms. I keep going back to that. That is the business fundamentally. What we try to do is spend money on the best credits, and we see quite a few, but we stick to what we know. We don't do energy, we don't do real estate. We're much more narrow than that, trying to find good long-term investments, right? And we're much more of a buy and hold lender, and we say no most of the time. We say yes to 2 to 3% of what we see in the unitranche format, which means we're doing more in high enterprise value software companies that are growing year over year. We're big into healthcare, as many people are in the CLO sector. Those are good B3 rated companies that we can evaluate. And then specialty consumer and other industrials, those are other verticals, but we're pretty narrow. We're consistent year in, year out, trying to find those good companies to lend to by partnering with what we see as the top 300 private equity firms. But we're not utilizing third-party agents to source deals for us.
You just touched on sectors a little bit, because private credit very much loves healthcare and tech, and maybe in a difficult environment like this, there's a kind of rush to quality, rush to kind of more recession-resilient industries. Is that kind of happening? Is there more focus on industries, and then does that create a problem for, say, diversity of portfolio management?
I think that's very different by manager, right? And I always say, when you're trying to evaluate the private credit sector, at least in the CLO sector, we're talking about leveraged loans, cash flowing loans, or recurring revenue ABS, the portfolio weighting is going to be materially different across the entire spectrum. Whereas if you look at the BSL market, it's the same. There's a ton of overlap. The top 10 guys pretty much have the exact same strategy. There's not a lot of differentiation. People can draw out certain points of differentiation that drive some of the pricing volatility that you see, but by and large, performance is the same. It's the same type of strategy. It's not at all like that in the private sector. So we may be more weighted to healthcare, and I think a lot of people are, but others have very little. Software is a huge vertical because it's great. When we think about the development of SaaS software, an incredible investment for a first lien lender. And you're going to see that show up in the BSL space as well as the private credit space. But away from that, it could be very, very different. We're talking about lenders who have specialties in hard assets or true ABL facilities or lower loan to value manufacturing companies. Like, that's going to be very different depending on the strategy. Some are more opportunistic, some are playing very much upmarket, more BSL centric, and that's where you start to see real differentiation across the manager spectrum.
Interesting. There's a question here with a like, so I think I should put it to you as well. What are the losses to date that you are seeing on your privately funded portfolio? Who wants to tackle that one?
I mean,
Easy, negligible,
Yeah.
yeah.
close to 0%. Obviously, you can look at our public filings to see where it is, but private credit portfolios have really held up really strongly across pretty much all managers, and I don't think any of us are speaking about increase in losses right now.
Again, I guess, the differentiation would be, there will be losses if you take an auto loan portfolio, there will be losses in the portfolio, but not our exposure, right? Because that's where structuring comes in, that's where the creativity and how you put it together come in. The actual portfolio, you may not want to fund each of those individual deal yourself, but because it's a portfolio approach, you are senior and there is other money ahead of you, you don't see losses in your own investment.
People saw a lot of losses in 2022 vintages for consumer and auto, right? And they're seeing improvements now, but that doesn't mean any of the lending deals got any hit. You've seen ratings hold up for the most part.
There's a question about geographies. Forgive my ignorance about in terms of how much you look at perhaps investments outside the US.
looking at for areas. We're very active in all of North America, Western Europe, and Australia. We've got offices in pretty much all the major cities there, and that's how we go about our business. Is we're big believers you have to have boots on the ground if you're starting to expand. And I'd say we're seeing attractive opportunities in pretty much every market. I'd just say sometimes the product focuses can be a little different. Like we're seeing a lot more fund finance in Europe than we are in the US. But so there's different dynamics, but there's attractive risk in both markets.
Yeah, for us, the ABS part is focused more on US and obviously Canada, North America, but other books, we have a lot of exposure in Europe and Australia, especially infrastructure and project finance space. We see a lot of deals, and we had a lot of them in Europe and Australia, and very strong deals.
We're pretty active across all of the geographies mentioned here: Europe, US, Asia, and again, each market has its own opportunities. But if I had to pick between the US and Europe, I think Europe could probably see more interesting opportunities in the near future.
Alan?
Yeah, we're growing in Europe slowly. We're not nearly as big as Ares, but we have a presence there. And part of that is really driven by the growth in private equity, as we've seen a need for US-based sponsors who are acquiring businesses overseas who want perhaps a loan structure that has multiple currencies. Then we started to get active there, and now we've got boots on the ground, and we're trying to provide the same type of value we have in the US to Europe. It's just a much smaller market, smaller companies, smaller opportunity sets. I don't think it's going to scale for us the way we've seen some of our peers grow quickly in the US.
Interesting. And so maybe just a forward-looking question over the next 12 months. We've talked about maybe losses are negligible. Is that going to remain the case for over the next 12 months, or is there going to be much more difficulties? Are we going to see?
I think if you have an office portfolio, you're probably going to start seeing some losses over the next 12 months. Look, obviously, I think for the next couple of years, what we're going to see is a lot of continued activity out of the banks, where you're going to see them need to exit business. We've been spending a lot of time for the last year finding ways to become partners with banks through this, because it's going to be an interesting time for the next couple of years where they're going to need creative solutions. So we think that's going to be very active.
Yeah, absolutely. I mean, I think, losses in the actual portfolio, we expect, especially if the consumer continues to feel the inflationary pressure and things don't come outside. And the key is going to be, I think, the unemployment levels. If they start to creep up, that's going to have a more severe impact on the portfolio performance. But do we expect to have losses in our ABS portfolio? Very unlikely, because we have triggers, we have turbos and whatnot, so that will amortize the deal. But yeah, office portfolio, yeah, we are working through some of those, the different book. And those, who knows how it unfolds. It may be a question of impairment. We are working with some of those deals to refi and things like those. So I think that's a different ball of wax, I guess. But otherwise, yeah, the structure should take care in the structured deals.
Nikon?
I mean, are we going to see zero losses? I don't know if I could say that with incredible confidence, but there will be challenges depending on sectors, and hopefully you've structured your way to a position where you feel somewhat protected and you have the expertise to get into the weeds if needed and try to maximize your value in a downside environment, right? Like commercial real estate is going to be an interesting sector the next 12 to 24 months, I guess, right? Like valuations have been challenged. Like it's valuations are definitely under pressure, and there's a good amount of debt. I think I read somewhere that's about $900 billion of debt coming due over the next 2 years. So it's there are going to be some challenges in that market. So.
Alan?
I think it's an interesting question. And again, I'm going to speak specifically to our portfolio and CLOs in general, so not real estate or autos. If you think about what BSL is doing, it's hyper competitive. There's not enough loan supply, and in a default, there's a lot of these up-tiering transactions that are really limiting the the collateral value for first lien lenders, right? And so I think there's recent research that says that defaults in BSL, if we think about recoveries at the time of defaults, given the ability for sponsors to move collateral away from the lenders, could be as low as 20%, right? 20, 25%. So that's significantly lower than what we know to be historical recovery rates in first lien loans. So one, I don't think there's going to be a lot of defaults. I think that's going to be very low. But the recovery value, given the control that we have and the relationship we have with sponsors, should be much, much higher. So it's a very timely question because it speaks to the competitive dynamics going on in the syndicated loan sector that investors are either unaware of or are willing to say, hey, we can diversify away from that risk. But I think in the private sector, there's such a higher level of control that losses will be lower.
So the golden age will continue, right?
Yes, it will.
Well, okay, that is time's up. Thank you, everyone here, for contributing to the panel, and thank you, everyone, for attending in the audience. It's been a very interesting discussion, and yeah, I'm sure we'll continue it. Thank you.
Thank you.
Thank you.